Welcome back to Carlton for Life. Today, we're going to be talking about one of the most controversial types of life insurance policies in the industry, and that's the IUL, Indexed Universal Life Insurance. Now, the reason I say they're the most controversial is because when I was getting my education on life insurance, I would come across agents that would say, listen, IULs are the best thing ever. It's a great retirement vehicle. Everyone should have them. Or I would come across agents that said the exact opposite, that they're scams, nobody should have them, and you should stay far away from them. Now, this difference confused me, right? Because I'm used to running into people that have differing opinions. This was a little different. Like people were at each other's heads about whether you should get them or shouldn't get them. And it was really part of the reason I actually went and got my life insurance license. Because I'm like, man, I need to learn why agents are selling them and why agents aren't selling them. I needed to get the behind the scenes and see what was going on in agencies. Now, after my education and my experience, I formed my own opinion on IULs, right? But I want to be clear before I start this video. It is not my purpose to do this video and convince agents to stop selling IULs. It's not my purpose to do this video and convince policy owners that have IULs to surrender them. And it's not my purpose to try to convince consumers in the market to either buy or not buy them. The purpose of this video is to give you the facts, to lay out everything and let you form an educated opinion on what you think about them. Now, I'm going to give my opinion because this is my channel. I don't think anyone should buy them. After my experience and after the education that I received on IULs, I don't think anyone should have them. But today, we're going to talk about the facts, and I hope that you're able to form your own opinion. Let's get into it. Listen, if you watch my channel, you know I usually never have notes, right? I can sit here and talk whole life insurance all day. It's super simple. For IUL, I got my notes today. A little more complex than whole life. Now, let's talk about what an IUL is. What is an indexed universal life insurance policy? An indexed universal life insurance policy is a specific type of permanent life insurance that combines a death benefit with a cash value. The cash value is tied to a stock market index like the S&P 500. Depending on the performance of the S&P 500, your account value will be credited. But there is a cap and a floor. Now, how does that work? Let me give you an example. Let's say you have an IUL and it's tied to the S&P 500. In a given year, the S&P 500 grows 15%. If you have a 10% cap and a 0% floor, then what that means is you'll only gain a credit of 10% because even though the S&P 500 did 15%, you have a 10% cap. Now, because you have a 0% floor, if the S&P 500 was to drop 15% that year, you would not lose any money in your cash value because your account cannot go under that 0% floor. Essentially, you have upside potential with no downside risk. That's how a life insurance agent would explain an IUL to you, right? And that doesn't sound too complicated, but it gets a little more complicated sometimes, right? Let's say if they're going to start adding a participation rate and a spread to the equation, right? If they end up using an engineered index instead of the S&P 500, and we'll talk about what an engineered index is later, but let's say instead of the S&P 500, they use an engineered index. These engineered indexes usually have no caps, right? 0% floor, no caps, but that means they have to have a participation rate, and that means they may have a spread, right? So the participation rate for an uncapped engineered index can be like 240%, but that may have a 5% spread to help them control costs. How would that work? Let's say that the engineered index does 10% in a given year. It's gained 10%. Because your participation rate is 240%, you multiply that 10% gain by the 240% participation rate, and your account can see a 24% credit. 10% times 240 participation rate. Now, because there's a 5% spread, instead of getting 24% credited, they'll take away 5%, and that'll give you a 19% credit to your cash value, right? That's how the participation rate and the spread works. Now, already we've talked S&P 500, engineered index, cap, floor, spread, participation rate. As you can see, IULs are kind of complex. And if you've already lost me by now, then believe me, you probably should not get an IUL. But if you're keeping up and you've heard this and it sounds good to you, the first question you need to be asking your agent is the question I asked them. How is this possible? Because I needed to know how a life insurance company could give you upside potential and pay you if the market does great, but doesn't have to pay you. I mean, doesn't have to take anything from your cash value if it does bad. Seems like they're taking on a lot of risk here while you're taking on no risk. I needed to understand how that was happening. Now, the first couple agents I asked didn't understand it. So I did a bunch of research and I figured it out, right? So with your cash value, they use it for an options budget. They go out and depending on what index your IUL is tied to, they buy a 1 year call option on that index. And if that index is profitable, then the call option is profitable and they can credit your account. If the index that year is not profitable and it takes a loss, the call option just expires worthless, so you don't have to worry about taking a loss. Now, if you don't understand the basics of how call options work and you didn't understand any of that, then you probably should not be getting an IUL. The fastest way to lose your money is to have it somewhere you don't understand. I'm not saying you need to know all the ins and outs of call options, but generally speaking, if you don't understand how a call option can be profitable and how it expires worthless, you probably need to study up on call options before you buy an IUL so you can understand how your account is being credited and how these companies are doing this. Now, if you're still keeping up with me, then you, like me, probably are thinking, you know what, these IULs sound pretty good. I can understand how the company can afford to take these risks because they're using call options. So when the stock market crashes, they're not actually taking a loss. That this call option is just expiring worthless. I was actually intrigued when I heard that. So when I started to do a little more research and dig really deep into IULs is when I realized I absolutely do not like them. I absolutely would not buy them. And as an agent, I absolutely would not sell them. Let's talk about why. So there's three reasons why I would not buy or sell an IUL. The first reason is overly optimistic and aggressive illustrations. The second reason, the lack of guarantees. The third reason, the cost of insurance structure. Before we start to talk about the overly optimistic illustrations, let's talk about illustrations in general. In a life insurance illustration, there's going to be a table that shows you how your cash value grows year over year, every single year of your policy, right? And there's something you have to understand about that table and your cash value growth. There will be a guaranteed side in your life insurance illustration that will show you no matter what, the life insurance company will guarantee you these numbers. That's worst case scenario. The life insurance company will also have a side that shows you best case scenario, what can happen with this policy. Now, as a consumer, something we need to understand when we're looking at these life insurance illustrations is there's always a degree of separation between what can happen and what will happen. And we always need to be focused on how far the distance is between the two. How far is the distance between what can happen and what will happen? Because just because you're looking at an illustration doesn't mean that that's what's going to happen to your cash value. Now, I'm going to quickly talk about how the illustration and the cash value growth works in a whole life insurance policy, just so you can get an understanding of how it works, because it's pretty simple, right? When you're looking at a whole life insurance policy and you're looking at the non guaranteed side, the numbers that you are looking at show you what can happen. If you were ever wondering what the distance between what can happen and what will happen in a whole life insurance policy is, basically, you need to think about what needs to happen. What do I need to happen for that cash value to grow the way it is in that non guaranteed column? And for a mutual company dividend paying whole life insurance policy, all that you need to happen for that non guaranteed side to grow the way it looks in the illustration is that the dividend has to continue to be paid. Now, as you already know, for mutual companies, some of them have paid their dividend every single year, literally for the last 150 years. So, as a consumer, when you're looking at the illustration, you can say, what are the chances that what's on this illustration will happen? How far is the distance between what can happen and what will happen? And if all I need to happen is for that dividend to continue to be paid over the next 30 or 40 years, then the separation isn't that far. It's not no separation, right? Because the dividend is not guaranteed. But I can assume and I can predict, I can say, you know what, I'm comfortable saying it might happen. The distance between what can happen and what will happen is pretty small. When you look at IULs, you will find that the distance between what can happen and will happen is pretty wide. I have here an IUL illustration of a 35-year-old male. It's for a $1 million death benefit, and it's about $850 a month. If we look at the illustration and we go down to the 30th year when the insured is 65 years old, we can see that over 30 years, he has put a little over 300,000 into the policy. If we look to the far right, we'll see the current illustrated values. This is best case scenario. This is what can happen, right? So after putting in a little over 300,000, he can have a cash value of almost 600,000 and a death benefit of still $1 million, right? So over time, he can pretty much double what he put into this policy while still paying for life insurance, which is great. Now, what needs to happen for him to get that number? If we look at that column, that current illustrated values, you'll see that there's a section that says weighted average interest rate, and it's 6.45% year over year. Basically, the stock market indexes that he's got his cash value tied to have to perform on average 6.45% every year for him to get this number. But it's a little more complex than that in an IUL, because not only do the stock market indexes have to perform at 6.45% every year, he also needs the life insurance company to keep the same participation rates, the same spreads, the same caps, the same floors. He needs all of that to stay consistent. And the life insurance company reserves the right to change those numbers if they deem necessary. So he needs stock market performance to remain on average 6.45%, and he's all those numbers to stay the same consistently over 30 years. The distance between what can happen and what will happen, as you can see, is a lot more wider in an IUL. You need a lot of things to happen consistently for this number to equal what it says in this illustration. We haven't even spoken about the fact that this just isn't based on the S&P 500. Earlier, I briefly spoke about engineered indexes. And what you have to know about life insurance illustrations is they used engineered indexes, not just the S&P 500. Now, the reason they use engineered indexes is because prices on the S&P 500 options are super expensive, right? They cannot offer uncapped potential growth and great participation rates on the S&P 500 because the options are too expensive. So to make the illustrations more appealing to clients, they use engineered indexes that pretty much they've created solely for the purpose of IUL sometimes to help them control cost in these policies, right? These policies, these indexes are called volatility control, right? If things get too volatile in the market, these indexes help the life insurance company keep costs down, right? Because they can move the numbers around inside the index, put more cash, put more bonds, and it kind of controls their risk, right? It helps them with their risk, and at the same time, it allows them to show you an illustration that has a uncapped potential growth, show you an illustration that has 240% participation rates and floors higher than 0%, right? So when we're looking at best case scenario here, it includes these engineered indexes, it includes the participation rates, the caps, the floors, all of this stuff has to happen consistently for you to get this number. Now, I'd like to also turn your attention to the middle column here, right? The alternative current illustrated values. This is, while the other numbers are best case scenario, this is a little more conservative view of what could happen, right? As you can see, that's 6.45% growth. This is 3% growth, right? And if we look at the cash value for a 65-year-old that had this policy for 30 years, it's only $287,000. So although he put over 300,000 into this policy, the more conservative projection and assumption on this illustration shows that he could have less than what he put into the policy, $287,000. So that's what you got to pay attention to. You're looking at an illustration where they're showing you double what you could have put into it, but you got to ask yourself, what's the distance between what can happen and what will happen? All of those variables make it very difficult. And all of those variables also are the reasons why these illustrations are sometimes called too optimistic and misleading, right? What are the chances that that's actually going to happen? You have to pay close attention to that. Now, the next reason that I do not like IULs is because of the lack of guarantees, right? If you get a whole life insurance policy, you get some guarantees. You pay your premium every month. you're guaranteed to have a death benefit. And in IUL, you can pay your premium every month. You're not always guaranteed to have a death benefit. You're not always guaranteed to have a cash value. Let's take a look at an illustration, the same illustration, but let's look at the guaranteed column, right? If we look at the guaranteed column in that very same illustration, let's go down to 30 years again. In the 30th year, when the gentleman is 65 years old, in the guaranteed cash value column, we're looking at about $116,000. We still put in a little over 300,000, but we're only guaranteed $116,000. Now I know a lot of people will say, listen, the chances of that, it wouldn't happen, right? This is what they have to show you as a guarantee. I don't care, right? When I'm looking at these numbers, if the guarantee is almost 200,000 less than what I put in, I don't like it. I don't like that I'm going to put over 300,000 in something and all you're guaranteeing me is 116,000 in cash value. But it gets even worse. If we look at 42 years later, when this gentleman is 76 years old and we look in the guaranteed column, look over at what he put in, $422,000. Look over at the cash value that's guaranteed to him. It says lapse. Look at the death benefit that's guaranteed to him at 76 years old. It says lapse. This life insurance company is not willing or is not able at 76 years old, after putting $422,000 into this policy, they are not willing or able to guarantee you anything. And if you look at this, after 42 years and 76 years old, the table ends. There's no more numbers. The policy is over from a guarantee perspective. They can no longer guarantee you anything. That's my second reason why I don't like IULs. I like to have guarantees. Those are not the guarantees I like to see. Now, the third reason I don't like IULs is cost of insurance. And it kind of ties into this guarantee problem, right? Because I'm sure you're wondering, why is this life insurance company not able to guarantee me anything as I get older, right? Why at 30 years old are you only guaranteeing me $115,000? Why at 76 can you guarantee me nothing and it's possible my life insurance policy will lapse? It's because the cost of insurance structure. It's important to understand, typically for all universal life policy, just not index universal life, but definitely universal life, the cost of insurance structure rises as the insured gets older. For example, this gentleman is paying $850 a month throughout the course of this policy, right? That first time, that first year that he paid $850, the majority of that $850 is going to go straight to the cash value because the cost of insurance is super inexpensive. Because the cost of insurance for an IUL resets every year. For example, if we're going to look at this policy, when this gentleman was 35 years old, for that 1 year, the cost of insurance was based on that 1 year. It's almost like buying a 1 year, $1 million policy. Statistically speaking, a 35-year-old will not die, right? So the cost of insurance for $1 million for him was super inexpensive. But what about the cost of insurance for a 65-year-old? A lot more expensive. And that's why the guaranteed cash value was only 115,000, because the cost of insurance has gotten a lot more expensive than it was 30 years ago. What's the cost of insurance for 1 year of $1 million for a 76-year-old? It's so expensive that even though you put $422,000 in a policy like this, they can only guarantee you a lapse, because that's how expensive the cost of insurance gets over time. Now, your agent will tell you, don't worry about that because your cash value will grow so well. By the time you get that old, it will be able to help with the cost of insurance. But to be fair, we didn't scroll down to 72 years old in the current illustrated values, best case scenario. Best case scenario, at 76 years old, at 76, you have the potential to have over $1.3 million in cash value. You have the potential to have over $1.4 million in death benefit. So truth be told, if that happens, then yes, maybe the cost of insurance can be absorbed and sustained by your cash value. But we already spoke about how likely that is to happen. And if it doesn't happen, if that cash value doesn't grow like that, then what are we guaranteed? Nothing. We also didn't speak about the fact, what if you take out a loan? What if you withdraw some of your money out of your life insurance policy, right? What if there's other things going on that we haven't even spoken about that can change the value of your cash in your policy. And then we're also worrying about the rising cost of insurance. It's too many things to have to pay attention to. And that's why I do not like IULs. That's three reasons right there. And I'm going to tell you something. I know what's going to happen already. Agents that are watching this, policy owners that are watching this, they're all going to say, listen, that was a horrible design. It's the way he designed that policy is why it turned out like that. Generally speaking, policies look way better than that illustration wise. He could have done a better job. That's what you'll always hear. It's all about how it's designed. To those people, I would like to turn their attention to AG 49. In 2015, the National Association of Insurance Commissioners, as a response to concerns that IUL illustrations were often too optimistic and misleading, particularly about how the policy would perform, they came out with these regulatory guidelines. What are these regulatory guidelines for? The main concern was that insurers were using overly aggressive assumptions about the performance of the underlying index, particularly in terms of interest crediting. So I know what the agents are going to say. They're going to say, listen, it's 2025. That was 10 years ago in 2015. We've changed things. We don't do that anymore. To those agents, I'd like you to turn their attention to AG 49A. 5 years after AG 49 came out, the National Association of Insurance Commissioners introduced in 2020 AG 49A, and it was to tighten the rules further and address loopholes in the original AG 49 guidelines. The revision aimed to improve consistency and transparency in IUL illustrations by addressing how insurers use the crediting method in illustrating rates. So 5 years after regulatory guidelines came out specifically for IUL illustrations, these companies were finding all kind of loopholes, and the National Association of Insurance Commissioners had to come out with more guidelines in 2020. Now, I know that agents are going to be like, listen, it's 2025. That was 5 years ago. We're not doing those things anymore. I'd like you to turn their attention to AG 49B. 2 years after AG 49A, the National Association of Insurance Commissioners introduced additional refinements to AG 49A, further tightening how illustrations for IUL should be created. Further limits on the assumed crediting rates, clarified additional limitations on how insurers could illustrate returns with specific attention to participation rates and how caps are used. They ensured that the impact of cost of insurance on projected values was considered more transparently. So, for anybody that tells you it depends on how the policy was designed, up until 2022, these designs were so aggressive, so overly optimistic that the National Association of Insurance Commissioners had to come up with guidelines to stop these life insurance companies from giving clients these illustrations that were not going to perform the way they looked. In a span of 7 years, they had to come out with three different regulatory guidelines. If the product is so safe, if there's so much upside potential and no downside risk, why do these life insurance companies have to keep coming out with loopholes to make them more attractive for the buyer? I don't want to know why. Me personally, I'm over it. I don't need any policy that has caps, spreads, participation rates, floors, engineered volatility controlled indexes. Why would I get something so complex and something so regulated? It's just unnecessary. For all of that, I'll get a simple whole life insurance policy. But that's just me. Like I said, I'm not trying to convince anybody of anything. I hope that this video gave everyone watching some form of education on IULs to get a basis going so you can understand it and you can make a more better informed decision about whether or not it's a policy you'd like to consider getting. If this information was useful for you, please like the channel and like this video. If this is content that you like, please subscribe to the channel. And if you know anybody considering buying an IUL and you think this video can help them in the process of trying to understand them a little better, please share this video with them. Thank you.